welcome to session 5 of the first day of Barranco's Entrepreneurs Week. It's our second occasion of running Entrepreneurs Week, and we've again been really delighted by the response we've had. My name is David Fletcher. I'm a partner in the corporate team at Farrers, and I act for entrepreneurs and investors, and I'm indeed delighted that some of the people I act for are speaking to you this afternoon, including Imran, who's powering up as we speak, ready to be fully energized to speak to you all. At Farrers, our focus is on acting for private businesses, family businesses, entrepreneurs and investors. So Entrepreneurs Week and what we're about to discuss during the session is incredibly important to us and our clients. And I think this session is one of the most important of the week. I'm not just saying that because I'm hosting it. As an entrepreneur, clearly investment plays an incredibly important role. Fundamentally, you need investment. You need the cash which investment brings to enable your business to grow. But also, as we come along to talk about getting investment, getting the right investment from the right people, forming those relationships is also incredibly important. I've seen that work really well, and I've seen it work not so well, including over the last few months. So a few bits of housekeeping. The format for this session, it's an hour long. We're going to start with me doing a brief explanation of people, introducing them. They'll each introduce themselves for a couple of minutes. I'll ask some questions, and then hopefully there'll be some time for Q&A at the end. This session is being recorded, so hopefully everyone's happy with that. It means that we can then put this back on our website afterwards, so www.entrepreneursweek.co.uk. And there's also an online poll I think everyone's had, so if you do get the chance, please do complete that, and again we'll feed back in the feedback afterwards. So brief introduction for your panel and speakers this evening. We've got Imran Khatri. Imran is has senior positions in investment banking, and now is CIO of his own family office. And he specializes in investing in a number of areas, including in startups. And in terms of sectors, that includes energy, technology, retail, and a common theme of disruption. Zoe Pedden's joining us. Zoe is also an experienced tech investor. She's now a VC investor for Ananda Impact Ventures. She co-founded one of the top apps in the EdTech area, My Choice Pad, and has won numerous awards. I read through all the awards, and they go on for quite some time. But I picked out the Elle Magazine UK Female Social Entrepreneur of the Year. So again, thank you, Zoe, for joining us. Ian Bernard is joining us from his august living room. Ian is the CEO of Capital Generation Partners, sits on all of their decision-making bodies, and ensures that CapGen is a good investor and a trustworthy partner. He's also got significant experience in corporate finance and in advising and helping his clients undertake direct investments. So really important. Thank you, Ian. George Davies is here. George is at Hambro Perks, who are a leading venture capital firm investing in the tech space in particular. George, before being at Hambro Perks, was a junior partner at McKinsey and has investment in a range of PE investments and growth strategies. Thank you, George. And then Cash is joining us. Cash at Aslam, who is at Dot Matrix. Dot Matrix work with a number of investors, private individuals making investments with entrepreneurs and tech investors across all sorts of ranges. He's been an investor and advisor on startups, investing in startups since 2012. Has 20 years of M&A experience, including at Citigroup and Blackstone, and has also served as a NED on a tech entrepreneur who IPO'd in 2016. So thank you all for joining. I'm going to ask you to be brief, and I probably failed myself to do that, but do you want to also say anything else before we get started? So I'll start with Imran. Do you want to say anything more about yourself and
No, you've stolen a lot of my thunder, actually. I had it all scripted out, David, and you've taken it all. But no, so as you said, we've kind of historically looked at investing across angel investment all the way up to Series A, across kind of three core sectors: energy, retail, fashion, education. But we like to look at a common theme of disruption technology. So the family office was set up around 3 years ago, and we've kind of actively now started looking at the market and diversifying away from what is our core proposition is kind of retail and residential properties and stuff like that. And we've also got an arm where we look at high impact infrastructure investing within development markets.
Brilliant. Thanks, Iman. That's great. Ian, did you want to go next and say a little bit more about yourself and CapGen?
Yeah, I guess, so thank you, David, for the introduction. What do we do? What are we for? I think what we do is we enable our clients to be good, effective, responsible investors. That includes, particularly for the purposes of this, enabling, facilitating, arranging investments in high growth businesses. We help invest in, manage our clients' real estate assets, and we also take care of their sort of long-term multi-asset pools of capital.
Brilliant. Thank you, Ian. Excellent. George, do you want to go next?
Thank you, David. Thanks for the introduction, and thank you to everyone for listening to us today. What would I add? I think what I'd add is, ultimately, if you think about what we do as a firm, we have two missions. One is to deliver outstanding returns to our investors by investing in technology companies across Europe and across the world. And the second is to enable entrepreneurs to build amazing companies in the technology space. And ultimately, that's what we think about every day. And we do that through seed funds, through our Series A venture fund, through a fund in the Middle East, which is focused on seed stage in that region, and a later stage secondary fund. But all of it is governed by a common theme, which is that we'll deliver outstanding returns for our investors if we back great entrepreneurs building great companies.
Brilliant. Excellent. Thanks, George. Zoe, do you want to go next? Well, I'm not sure if I know Zoe's dialing in from a leading hotel chain, so maybe a slight problem with the connection. Cash, do you want to go next, and then hopefully Zoe will be fine after that?
Yeah, sure, David. Thanks for having me on. So yeah, Dot Matrix Group. We're an angel investment syndicate. We've got 70 high net worths in our syndicate, and we go out to them with our sort of diligence investment opportunities, and we invest ourselves personally. Myself and my co-founder, we present our diligence and what we've learnt, the reasons why we think they're good, what you need to believe for the startup to succeed, and what we've learnt about them along the way. And we like to build long relationships with entrepreneurs and their startups before we invest. And I can see some familiar names in your attendees list. So we like to get to know people for a while. And sometimes people can be disappointed because usually they're out there talking to investors, they're looking to raise money, and they want an answer within days or weeks. But we're sort of a bit more sort of longer term, and we learn a lot about the startup as we see them execute over time. So our sort of three phrases that we have are to contribute, learn, and invest. So we want to contribute, help the startups. We want to learn from them, and hopefully they can learn from us. And we want to invest as well. So yeah, the learning is really important. We really like entrepreneurs and startups who are open book and willing to learn and share, what's going well, what's not going well. How can we all be better in the ecosystem? We all need each other to succeed. So that's how we think about it.
Excellent, brilliant. Thanks, Cash. Zoe, I'm not sure if you can. Oh, there you go. You're back.
Yeah, I keep going in and out. My Wi-Fi is terrible. I'm really sorry, everyone.
No problem at all. Did you want to say a few words?
Yeah, I'll make it few before I drop out again. So we're Ananda B2B software focus, across Europe with European impact, really important that bit. Preference for late seed Series A. Initial ticket 1 to 3 million, and we invest up to 7.5 million. We too tend to build relationships over a long length of time. We want to get to know them better. We invest in digital health, sustainability tech, lifelong learning, age tech, and software that encourages equality. All those impact areas.
Brilliant, excellent, thanks, Eddie. And actually, broadband problems are one thing, but I remember last year at Entrepreneurs Week, one of our last sessions, we were interrupted because water started flooding through the ceiling. So given the choice, I'm going with broadband, but no, that's great, thank you. One of the great advantages of this panel is actually the broad range of different experiences and different areas and stages you all invest. So can I start with a really general question about the market? Do you want to say a little bit about how you've seen, your perspective, how the market's changed over, well, since March, and really including today, because obviously it's quite dramatic changes on the public markets today. So any thoughts first, or I'll pick on you, Imran, to kick us off, if that's all right.
So I think it's strange, right? So if we look at the markets right now, effectively, I think capital has become a lot more expensive. If I think about what I'm doing with my own personal investment thesis, we've slightly retrenched, but not retrenched in terms of that we're not investing. We're still actively looking to invest, but we're very much looking at stronger fundamentals than we historically would. So where in which we would have looked at something a little bit earlier stage. I think the focus around the management team, the execution capability, is a lot more paramount than it ever has been before. We're also keeping capital in reserve to support some of our businesses that are probably going through a little bit of a harder time than they historically have, right? So where in which, as kind of Zoe mentioned earlier on, we have follow-on money earmarked for people. We're finding that that follow-on money is potentially needed a little bit earlier than we would envisage, because I say the landscape has considerably changed.
And so, okay, well, maybe we'll come back and I'll ask some questions after that. So, George, do you want to go next?
Sure. I mean, it's one of those questions I was reflecting on before we spoke, and I was thinking I could go on for hours. So I tried to boil it down into the world that we work in venture, into what do I think since March, April time has been most significant in my mind. So I think there's three things. So the first is, I think what we've seen anyway is a sort of pretty robust bifurcation of the market. So the best businesses continue to get backed. And actually there's a lot of capital chasing after the most exciting investment opportunities. I think where there'd been some looser investing further down the quality scale, as I would perceive it, I think companies have struggled more because I think people have been more cautious. But I think the best businesses, and we've certainly seen this in our portfolio, that many of our best companies raised capital during this crisis, or whatever we want to call it, and did so at very healthy valuations, and their performances continue to be very good. So many of them absolutely outstanding fundraisers from the perspective of our investors. But those for the really top companies, I think that will continue to be the case. The second thing that I think has been pretty interesting is, look, the impact of COVID itself is, broad and varied, right? I mean, if you just look at the investments that we've made, there are sectors which have had a really tough time, and where we do have a little bit of exposure, although we've been quite fortunate that we don't have much. But obviously I'm thinking of things like travel and hospitality, retail, where, I think you'd describe this as somewhat existential, at least in the short term. And so that's been very challenging. Now, obviously, as technology investors, we've mostly been able to steer clear of that, but the real economy is suffering, and that's not a good thing, because that's following through into jobs and all the rest of it. On the other hand, a lot of it has done incredibly well, right? So we have a lot of exposure to enterprise software, healthcare software, education technology, all of which have had enormous tailwinds, right? So some of our actually pre-COVID sort of average performing companies in those sectors have enjoyed enormous tailwinds. And I would say that in some of those sectors, we've seen, 5 years worth of change in 6 weeks. We have a fantastic investment, for example, in a business which is a digital video content library for educators, right? It was already a good company. Now it's an unbelievably good company, because that behavioral change has happened incredibly quickly. And the third thing that I think has been very interesting for entrepreneurs and venture capitalists and venture debt providers and private equity funds and everything else has been this really interesting role of government. So government has come into the market in quite an interesting way. I think that's been overall a good thing for innovation, for jobs. It has all kinds of long-term implications that I think are yet to be ironed out. but I think that the important role that government has played has been a sort of overarching theme. So those are the three things that I would highlight above all: the mixed role of mixed impact of COVID, a bifurcation of the market and a sort of flight to quality, and then the growing role of government.
Brilliant. Thanks, George. Really helpful. There's a couple of things I want to come back to, but we'll go through first. So whilst your system seems to be working okay, do you want to have a go next? And what's your experience been since March?
Yeah, so very quickly again, before I go down, more founders seen than ever in a short space of time. So I've been able to see around 70 to 80 in the last few months, which has been fantastic. I'm missing the more in-depth relationship from normally would go to a second or third in-person conversation, and I've not been able to do that. So that's not so fantastic. But then on the plus side, we have a lot of investments in.
We may never find out what Zoe has all her investments in. This is tantalizing. We'll come back to Zoe to find that answer. Or but Cash, you might need to know what Zoe's invested in, but probably not. Do you want to say what areas and what your experience has been?
Well, I think there's been a few step changes actually. I think since March, in March, it was really about just fighting for cash flow. What can we do? What can we do to survive our cash flow position? And very quickly, our startups were starting to renegotiate their rent with their landlords, making use of the furlough scheme that was sort of coming through. Pay cuts across the board, and for some startups, the top team put a pause on their pay. And really, at that point, we didn't know how it was going to unfold. It was just about cash preservation. And I think around sort of June, July, once it was clearer how this is playing out, then business plans were being revised, and discussions started again with investors. And just as that's when the equity market started picking up as well, then suddenly we saw there was much more appetite to invest. I mean, some of the discussions we were having in January, February, they just stopped in March, and we just were not ready to invest then. But then post July, August, and now quite strongly this month, we've seen very strong appetite from angel investors on the back of higher equity market valuations, looking at businesses who've adapted well, preserved cash. As George said, strong businesses were able to raise. I think it was a mix actually of strong businesses and businesses who were backed by deep-pocketed investors who are able to sort of raise money in this time. But there's been a lot of activity, a lot of startups raising money in August and September. And August was actually probably a busier month than we normally would see, because everyone's sort of one screen away from a conversation. So the future business shape, business plans are revised. Valuations are flat on where they were last year, generally in sort of new rounds. But those who've adapted themselves, they're well positioned with new opportunities ahead.
Excellent, thanks guys. Zoe, do you want to finish off there? What the areas you were investing in, because we're all on tenterhooks.
So digital health and education, the government, it was mentioned before, the size of the grants have been substantial, and we've been able to see some of our portfolio have really benefited, let's just say. And education and healthcare, the fantastic areas. We're really glad we put a fair amount into that. So we did pull back at the beginning. We made all the cuts like everyone else, offices and things. But then as time went on, the NHS started to bounce back. And the healthcare ones have really benefited from this. I guess it's not all bad news is what I'm saying. There's some that are really riding this wave and doing really well. It's good to see.
Brilliant. Excellent, thank you, fantastic. Ian, to finish us off.
I guess I mean, so we're quite a broadly based business. So we do direct investments in high growth businesses, but we also own real estate directly in multi-asset portfolios. I guess I've got quite a broad view. I suppose, what's the impact of COVID? I think part of it has just been to sort of put the foot on the accelerator of stuff that was happening anyway. So, digitalization, miniaturization, disintermediation, all the things that have been going on for, well, depends when you start the clock, but which have been accelerating in the last few years as we've embraced more and more technology, and technology has enabled us to do more and more things. That's just been accelerated. So home shopping, the delivery of services and goods to the home, whether that's education, your Amazon delivery, I think that's all just gone much, much faster. And therefore the losers of that become much more visible. So I think, there's a big, what's changed since March, the winning and losing sectors are much clearer, and the winners are pretty evident. But I think that's only one dimension. I think the other dimension is your balance sheet. So, there are people in inverted commas, losing sectors or challenged sectors, with strong balance sheets that, are going to be okay. And you sort of do a 2 by 2, are you in the right sector or the wrong sector? Do you have the wrong balance sheet or the right balance sheet? If you're in the wrong sector with the wrong balance sheet, you're in deep trouble. If you're in the wrong sector with a decent balance sheet, and I take a sort of, from a real estate point of view, let's look at what the Grosvenors are doing in London, where, real estate's under a lot of pressure. But they've taken a strategic decision, which they can, because they've got a super robust balance sheet, that they're going to protect all of their tenants. And their strategic view is they will be the winner in a struggling sector because all their competitors are going to go out of business. So I think that sort of interplay between, which sector you're in and what your balance sheet looks like is quite important. I guess, and then sort of going out to, and as real estate folk, because we our clients own businesses, we are on the other side of Cash's businesses that are busy renegotiating their leases with their landlords, and we have to manage that and think strategically. I suppose the other observation I would make, and it was interesting what Imran was saying about sort of cost of capital, because I guess when I look at what's happening in public equity markets, we've seen the most extraordinary surge in growth businesses. Most of the movement in MSCI world, in any sort of market indices, have been entirely driven by a few tech businesses. Most industries are flatlining or falling in value. So you've seen this tremendous surge of capital into these fan mag businesses and others, whether in the US or elsewhere, which made them quite expensive. So I'm sitting there thinking, God, that's really pricey. You want to own growth and the future and the transformation that needs to take place in the way we organize ourselves to deal with challenges that face us, like the environment. But that looks quite pricey. And I suppose from a very practical point of view, it makes the smaller direct investments we can do much more interesting, because if you've got this choice, do I make or do I buy? Buying Apple's pretty expensive. Buying Tesla's even more expensive. Much more attractive maybe to make and to be involved as an investor at a much earlier stage in a company's development, and in a way get access to growth and innovation at, frankly, a better price than, as far as I can see, you get from buying Tesla right now. But I'm not, by the way, I'm not giving a stock pick.
Oh, brilliant. Thanks, Ian. And just out of interest, really, just you're looking at the market since March, so before March, during the period, and there's an awful lot of has happened in that time. In terms of liquidity which is there and the appetite from investors and what that means for pricing, how have you seen that change? Is that better for you as an investor? Because actually before you might have seen 2 or 3 or 5 other people interested, and now it's you, maybe one other, or are we still talking that sort of bifurcation? And actually for some that's true, but actually for the most popular ones, it's still competition. Does anybody want to comment on that?
I mean, maybe I'm talking too much, but I think my sense is that I think it's really, if you're trying to raise money right now for an extraction play, some sort of gas play somewhere in, I don't know, Iraq, I think that's going to be really, really hard going. I mean, really, really hard going. I mean, you're on the wrong side of history, and you're on the wrong side of sort of current perceptions of what the long-term value of that asset is going to be. So I think that must be really, really hard. My sense is, and the things that we're doing, and we're a small bit of the market, is that high quality businesses remain as, if not more, attractive to investors, speaking as one, than they did 12 months ago. And that's that combination, by the way, of sector and balance sheet. And obviously your sort of top right hand corner is being in the right sector and having a good balance sheet. That's, those businesses are super attractive.
Yeah, I think I'm on the other side of that a little bit, right? I think we've seen some firms being caught out a little bit by COVID. What that effectively means that they've had to accelerate their capital requirements compared to where they would have. So for myself personally, compared to an Ambrose or something like that, where we can move a little bit quicker, there is a level of due diligence, we're finding that we're able to negotiate values down. Not in a horrible way to destroy the company, but ultimately there is a requirement for quick capital release, which from a family office perspective, we can do quite quickly. Yes, they're still competitive. So it is not, I think it's fair to say that good is good irrespective of market conditions, right? And they will survive, but they've just come to the point in which it's caught, similar to all of us, unexpectedly. And so retrenching has meant raising capital. We've been able to aggressively reduce.
Yeah, thanks, Ian. What about George? Have your sort of observations on the market, both in terms of price and competition? Because my general sense was it was a lot of activity, a lot of appetite beginning of this year across the market, particularly the tech area. Has some of that dropped off? Or was there still cash out there?
I still think there's investment capital for outstanding entrepreneurs and for great businesses. I think that the sort of dampening plays out more in two ways, and there was a Q&A question that slightly touched on this as well. I think it plays out in that valuations will be down, particularly at the earlier stage, in my opinion. So there's a sense that the sort of power of fear of missing out and the power of momentum, but really very intangible momentum feeding through to very high early stage valuations, I think, thank goodness, is kind of has petered out somewhat. I think that's a very good thing for basically everyone involved, actually, including the entrepreneurs. Although it requires a bit more dilution, it ultimately means more supportive, longer term investors with a bit more thought and less of the momentum plays that often aren't such a good thing, particularly when the tide starts to go out. But I do also think that investors have remembered that they need to look at the fundamentals too. And there was a period of time there in the earlier stage where that was a little irrational. What I would also say is, I think you're seeing this in the late stage of venture as well, right? So if you look at an interesting case example, might be late stage fintechs in the UK is a good example, right? Where there's a lot of businesses there that had raised large amounts of money, had interesting traction, but actually, the private markets have started to punish a lack of fundamental, at scale unit economics, right? And they've started to punish a lack of, outstanding traction in this environment. Monzo being a very good example of that, where Monzo lost its CEO, quite a lot of its executive team, effectively did quite a challenging funding round. That doesn't mean it's not a really interesting business. It's not one that I personally want to invest in, but there are plenty of very smart people who do, and there's a lot to be said for it. But the market was less forgiving of that. And I think we're seeing more and more examples of that. So I think it plays throughout.
I agree. I feel like the pendulum has swung a bit away from growth at all costs towards demonstrating ability to get to profitability faster now, even if it's at the expense of growth now. There's definitely, both from the entrepreneurial mindset as well as the investor mindset, a swing more towards profitability now.
I think that's absolutely right. The only thing I would say to slightly, dampen my own comments is ultimately the thing that gets venture capitalists really excited is exponential growth. And when they see exponential growth, I think they'll still pay almost anything for it, because it's actually incredibly rare. But by and large, I agree with cash.
Zoe mentioned a point which was cover this, and then I might just skip on to the advice for entrepreneurs, so the people listening. But I thought it was interesting the point you made, Zoe, around you've been able to see more people probably quicker, which has good and bad aspects to it. And I just wondered, in terms of comments on that, is that a sort of familiar point that now you're able via Zoom, via MS Teams, to have more conversations, possibly more efficiently? How's that worked? And trying to crystal ball gaze a little bit, do you think that will stick? So you made the point, you wanted to comment further?
I mean, most of my team is based out of Munich, which is where I am now with the bad Wi-Fi. But so we've always in the past had to fly people over to meet the rest of the team. They were very keen on having a physical relationship. Now that's dumped. So this is fantastic. So I can get more people in front of them more easily now. So for me, it's improved the efficiency of how we work. So that's going to keep. I do think I'll continue to do more first round ones by Zoom, but I would prefer to do the second or third meetings in person so you get to know them a bit better. So there's some elements I'll be keeping, but others I'll be trying to drop.
Okay, that's interesting. So there's a bit of a combination of the two, sort of a filter process to begin with. Can I move on? Because I'm just looking at the time, and I want to have some time for some Q&A. So entrepreneurs listening to this are going to be at various stages. One question I was going to ask is, how can an entrepreneur best impress you? So if they're getting in contact with any of you after this call thinking, this is great, definitely want cash to put into the money, or Imran, if he's as good in person as he is on the screen, he's got to invest in my business. What do you look for? Both in terms of very practical points, what kind of information do you want through when? And then further, what do you look for in terms of meeting them and how to build a relationship? What do you value in that? Imran, do you want to start? Because I've highlighted you in particular.
Thanks. So I guess there's two things. I think for me, fundamentally, because I like to get quite hands-on with the business, meaning sitting on a NED perspective. So I look at it from a personal perspective, and actually, how do I get on with that individual? Right? Do we have similar thoughts? What are their strategy? Does it align to what we're thinking? Do I agree with where they're trying to take the organization? So I very much, first of all, look at the individual and think, is that someone I work with? But also, I think, as we said before, do I trust that person? I'm about to write you a check for £500,000, £100,000. Do I trust that you're going to deliver what you've suggested that you're going to deliver on a piece of paper, right? So, and not just you, but you and your management team as a collective. That, I think, is the first parameter. If that person gets that tick, then we're kind of happily looking, going, well, what does that company do? Are you making a change, right? We've seen some real behavioral changes in the way that the world works now. You know, the Zoom stock price clearly depicts that we're now very much doing a different way of working, right? And how does that now fit in, especially in the current climate, right? So EdTech is another fantastic one, as kind of Zoe mentioned. People are now, we're changing to a new way of interacting with people. We're changing to a new way of learning, which all of our behaviors are changing. So this is going to be a very seismic shift for everyone's way of working and moving forward and just living. And so that becomes the other thing, is, does it fit into this new cultural world that we're going to live in?
Yeah, I would echo that. Learning, very important for us. We want to see the entrepreneur being open and honest about what's good and what's and where the challenges are, whether that's the challenge in the business or in the team. No business is perfect, even though every sort of pitch deck will tell you, everything is amazing in that company. We need to know what the reality is, and I think it's a good question that Imran raises about trust. How can you trust someone? And you only want to feel comfortable if you to invest if you do trust. For us, we need to get to know them over time. We need to get to know the company over time to see how they execute over time, and then we can see if they haven't delivered what they were expecting, then what have they learned from that, and how have they pivoted their business, and how, with the changes in the market opportunity, what has that meant for the business? So just learning from them, from their twists and turns, can be very telling as well.
Yeah, I would agree. Just from a personal point of view, I do think the remote working speaking personally, has enabled me to do more sort of early stage stuff, because it's okay to have an introductory meeting or discussion through Teams or Zoom, and maybe that's an hour of your time, whereas a physical meeting, if it was on one side of London or another, or if it was another city, would range from a few hours to a day. So I do think the sort of ability to access things is I've found has been enhanced. I think the bit that for me anyway is still a struggle is getting to there's a high conviction decision you need to take about deploying money. It's getting to that point where you feel comfortable, and we express it in terms of trust, and that's what it is. Do you really actually learn something by meeting somebody in the flesh? There's lots of evidence that interviewing is a very poor selection tool, but I think what it does do is it creates a bond. So maybe trust is just the bond. But anyway, I think that it is a thing. So I think the what we found in practice, what does it mean, is we do quite a lot of preparatory work remotely on Zoom, but then there needs to be some some face-to-face contact, just to create the bond that will enable you to sort of stick with each other if times get tough. In terms of what do entrepreneurs and what does people seeking capital have to do, I'm not sure that's hugely changed from my point of view. It's maybe been enhanced. It's about clarity. I think that from an investor point of view, you want to be clear about what the business is, what it's for, how does it help the world, why should it be there, and how is this capital going to be meaningfully transformative. And I think also to understand whether we're more than money, because I think there's money, and there's money with there's more than money, and I think our goal would be to be more than money, partly because it's just more fun, more interesting if you can contribute to how business is growing. But I think it's purposeful as well, in the sense that if you're in a position to help transform the outcomes, that makes a huge difference.
Yeah,
I might have a slightly different angle on this, just in terms of I think I'd echo a lot of what was said, and I think Ian is right in terms of has what we're looking for changed. Maybe the way we find it's changed a bit, but I think the way what we're looking for in people hasn't changed a great deal. Ultimately, in venture, we're looking to invest in a very, very small proportion of the opportunities that we see, right? And so when we think about the people that we back, we think about ourselves going into partnership with them, right? As Ian said, and we think of ourselves as much more than just money. And we don't have a sort of tick box for this, and we sort of spend a lot of time thinking deeply about how we assess teams. There are 3 or 4 things that we certainly look for that I think are worth just mentioning. Firstly, we look for really deeply talented, almost kind of edge personalities, right? I think the people who are great entrepreneurs have something special about them that's quite hard to put your finger on, but you know it when you see it. And and often they're not just the easiest people in the world or the most friendly, right? It's the people who are really capable of going all the way that we're looking to back. And I think about it in those terms. But coupled with that, we always look for people with great values, something that's quite hard to test. It means a lot of referencing, a lot of deep conversations. But ultimately, we think that the people that we back reflect, hopefully, what we are as a firm as well. And so we care, and we touched on that in some ways, right, with trust. But there's, in my mind, there's a bit more to it than that. Even though I take that word quite broadly. The third thing that we look for, certainly I look for as an investor in people, is evidence of the ability to actually lead, right? So if you want to build a really, really big company, you're going to need to get a whole bunch of talented people who who are hopefully more talented than you to buy into your vision, believe in you, and work with you. And so we're looking for evidence that these are people who can build highly talented teams that can go all the way. And then the final thing, and it's not that we necessarily need all these things, although they are, in most cases, relatively red lines. The final thing is we really like genuine domain expertise. We like people who can demonstrably show that they really know things. I don't believe in the world of sort of generalist entrepreneurs, really. Of course, to an extent, but they need some deep expertise that's relevant to the problem they're solving, be it sector or be it technological. Because otherwise, it's going to get a lot harder, and we need to be backing people who can weather storms like the one we've just seen. We've tended to back more experienced entrepreneurs as a firm, and the time since the beginning of March has been a period in which we've been very glad of that. So that's something we look forward to.
Yeah, I guess a little bit to that though. Personally, I'm happy to look down inexperience as long as the management team or the supporting structure, either via advisors and stuff like that, I think are important, because not only is entrepreneurship becoming a little bit more fashionable, so everyone slightly become an entrepreneur, but if you can get the right team structure around you, I think that also sets people up for success. So I wouldn't look at the individual for their experience, but more broadly the team that they've got around them. I guess that's quite important for us.
And would you all be prepared, therefore, to back an individual and a team 100% remotely, or would you always want to, at some point, meet them in person? I'm just thinking, have a lot of your investments actually been ones which started pre-March, and therefore you haven't had to test this, or have you actually gone through with investment 100% virtual, as it were? I mean, I guess if you're based in Munich, does that come up? There's just people who are global, and therefore physical meetings just aren't possible sometimes.
We've met all in person at least once. The rest of the time we do a lot remotely, but we've met them at least once. So that's what we're finding quite hard at the moment.
No, fair enough. Can I come on then to ask some questions which have been put by by some of the audience? So one of the questions Albert raised was regarding the stage of investment and whether you found a sort of more appetite to invest at slightly later stage companies and less at the startup stage. And slightly linked to that, Albert's sort of second follow-on question there was, George mentioned investing in quality and just trying to delve into that a little bit more as to what quality really means and how you assess quality, which I sort of touched on there, George. So maybe focusing on the first point is, what stage are you comfortable investing normally, and has that changed as a result of what's happened over the last few months? And then if there's any second comments on quality, that would be interesting. And so yeah, I think I'm right in saying you're more sort of later stage anyway normally. Is it more sort of Series B onwards? Is that right?
We're late seed Series A. It hasn't changed at all. So
right.
For us, we've all got revenue and we've just remained the same. In fact, we're just carrying on as normal from now on, since God knows what's going to happen over the next 6 months. This is the way of life now. So.
That's true. Cash.matrix, you all sort of certainly will be prepared to back complete startups once you've got the relationship. But again, has that changed at all over the last few months?
That's the same. So we are at sort of seed and Series A, and companies with revenue. That remains the same. The same. So yes, I guess in the new world, maybe it is more challenging to get your startup moving along and get those first customers. But yes, that's what we need to see, that traction. So that has not changed.
No. Okay. And then George, at Hambro Perks, is it both at stage and actually Cash's point about post revenue? What's your sort of minimum criteria?
Nothing has changed due to COVID on that. The stage question depends on which fund we're investing from. We have a secondary fund which invests later stage, for example. and we have a balance sheet that's able to build companies effectively in partnership with entrepreneurs, so we can start day one. So no, that hasn't changed the way we're approaching things, and we don't expect it to. Simple as that.
Excellent. Imran, we're going to go for a clean sweep here potentially if nothing has changed.
Yeah, and nothing has changed. I think. Yeah, easy. It's an easy answer, right?
Yeah, exactly. I wish I hadn't asked the question.
But I think, as I said, the fundamentals are still there. We're probably reinforcing the fundamentals and analyzing a little bit more. I think we said earlier the slightly take a risk on it. Does that make sense? Does it align? It ticks 8 out of 10 boxes. We would have taken a risk probably but now it has got to be closer aligned to those basic fundamentals, and you need a 10 out of 10 to a certain extent. But not much has changed generally. This criteria is still consistent.
One thing I would say that has changed is corporates or sort of strategic investors who are being disrupted. We've seen more interest from them at earlier stage companies, and looking at ways to collaborate. So whether that's retailers, banks, companies in the hospitality space, we're seeing a lot more activity from them in looking to either do commercial partnerships, not necessarily investing, but commercial partnerships, or investing into startups and earlier stage than what they normally would be comfortable with. They're just worried that they don't want to be disrupted out of existence in the future in the new world. And we're seeing a lot more conversations. We're helping our portfolio companies in those discussions much more.
That's interesting. Thanks, Cash. Ian, do you have any to add on this?
I mean, we're doing something a little bit different because I think my colleagues are very much sort of principal investors, and whereas a lot of what we're doing is helping our clients manage their own deal flow. So what does that mean? I think it means that we've done a range of things over the years, from pretty early stage stuff to stuff that's later. I would say generally we pre-revenue it happened, but it's not really our sweet spot. It tends to be post-revenue, ideally with some profitability, and there's some sort of sector concentrations in that. Has anything changed in the last 6 months in what we're doing? No, probably not, actually, if I'm honest. I mean, you've got. I'm just thinking of a sort of very specific example, and this is an investment that happened before, but it's been we understand this business much better now. I mean, way better, and what does that mean? It means we understand the customers for this company's product much better. We had a view on it when we underwrote the original investment, and the resilience, the revenue's been just surprised me. Really has been fantastic. So I suppose we probably have, maybe I'm generalising from that one example, much greater confidence in the investment because we've seen the business tested. We understand the business better because we understand what the ultimate customers of that business want from it, and they want more from it than we'd imagined. So I think we're sort of richer. Our knowledge is richer about the businesses that we own or have stakes in. But our sort of going in criteria, I don't think have hugely changed, actually. We will apply the lessons we've learned when thinking about businesses that we're looking at the moment. We will apply some of the lessons we've learned about what's happened to revenue in other areas when thinking about the resilience of their businesses. So that's a richer set of knowledge and information more than changing criteria.
Interesting point Cash mentioned around sort of what we might call private capital and the difference between that and trade deals, because that maybe I think our experience in terms of our clients was that it was really interesting how quickly we went from March, sense of panic with some investors private investors, none of you, who stopped, and then but very quickly by the time we were at the end of April were back active again, whereas the trade buyers have mostly said we're going to look to the autumn and consider it at that point, which may just be because they themselves have got a lot to do and haven't got the appetite to take on more deals at this point in time. So that's interesting. touching on another aspect, I suppose, just again for entrepreneurs who are listening to you, are there any things, whether it's the last 6 months or more generally, any sort of tips or things to avoid, things you've seen in terms of whether people, how they approach you or just how they operate their businesses, where you commonly see and you think, well, look, there's one thing I would say, don't do this.
I can give you one very concrete thing there, which is just always tell the truth and always be as open as possible. I think it's comes back to trust, right? We have not done investments in companies that we otherwise liked, where we felt during our due diligence that we discovered things that may not even have been fatal, but that we feel when we looked at each other as partners around the investment committee table, would I want you to have told me that, right? Even if it's not a, you know, and ultimately I think you basically only get one go. We will go into an interaction assuming that people are acting in good faith and behaving in a trustworthy and open manner. But I think that assumption, it doesn't get tested, right? If it's tested, it's probably not going to work. And I think ultimately we all understand that building businesses is really hard, and it is a very winding and uncertain road. And we all have that context. I think what makes it very difficult for you is if you sort of look to gloss over things too much to the point where it no longer feels like a conversation based on strong foundations. So that'd be one very strong lookout that I would advise everyone for.
Great, thanks, George.
Yeah, I would say, you know, in there we always see a forecast plan with target revenues and you know, sometimes profits, and sometimes the forecast we see, we know the entrepreneur does not believe that there's any chance of hitting those, but they just feel sort of compelled to put up these sort of charts with these hockey sticks, and we can just see even in the near term they're not going to hit their numbers for this current fiscal year. So yeah, you know, honesty is paramount.
I guess, I mean, said with humility, because, you know, setting up and growing and successfully running a business is not easy. It's really hard. But I suppose the two besetting sins I think I see in entrepreneurs or business founders are one, just micromanaging, where you see an entrepreneur. I mean, you need to know your business, but that's a separate thing from micromanaging. So I suppose it makes us anxious to see somebody that is overly focused on the sort of minute by minute or day-to-day operations and tinkering. I think the other besetting sin is the sort of pursuit of short-term revenue, and you know, obviously that's easy to say because, you know, when you're in a startup business, how you're going to pay the bills and all that sort of stuff. But I think, you know, I've seen over the years many instances where people have chosen to make a penny today rather than the pound tomorrow, and that sort of over focus on short-term revenue, I think, is a problem. You know, said, you know, makes it sound simplistic, but I think, you know, what we're looking for in entrepreneurs are people who can, who've got a clearly identified the purpose of the business they're founding, very, very clear strategy, have picked really, really good people, and then, you know, have raised and continue to raise the money in order to be able to support the people delivering the strategy to align with the purpose that they've set out. And I think, you know, back to my comment about, you know, chasing day-to-day revenue, I sometimes feel that, you know, it's really hard raising money. It's actually very hard raising money in Europe. It's relatively easier raising capital, I think, in the US. And so it feels different, but I see entrepreneurs doing things, and I think, well, actually, what you should really be doing is just go and raise a decent amount of money, and that sort of will unlock other stuff. Easier said than done. It's not a great particularly market relatively in Europe compared to the US. I think the arrival of you know, more sophisticated financial sponsors has been a great help, but that would be my sort of guidance. Just avoid chasing short-term revenue, avoid micromanaging, concentrate on the really, really important stuff. And to the point of your Entrepreneurs Week, David, you know, getting the making sure you are managing the balance sheet, the capital structure well, bringing the money in, making sure it happens regularly, making sure there's an uptick in valuation, is a really, really vital part of being a good entrepreneur.
Brilliant. Thanks, Ian. I think I'm going to sum up because I want to finish on time. Just in terms of all of you, if there's people out there who are listening and want to get in touch, can they do that, and what will be the best way of doing so without you all being inundated? Everyone's put the details in the chat bar, or just say no, actually.
The answer is, of course, yes.
Question in the chat.
Great. Well, actually, I think all your details are on the on our microsite as well. So if you're all happy, then
Absolutely, that'll work.
Excellent. Good. Thanks, George. So, well, I think I'm going to probably wrap up actually to make sure we finish on time. So, a really interesting, fascinating conversation. And thank you all so much for your time and for coming along speaking this evening. One thing I found really interesting, modern world, all the changes which are going on, we're all here on Zoom, and yet the one things which came up were really quite traditional aspects and attributes: honesty, trust, leadership, values. So fascinating, really fascinating that some things change and some things really do stay the same in terms of the core characteristics which you're all looking for in entrepreneurs and the people you're prepared to back. I wholeheartedly agree, and that's what we look for with our, well, actually people we work with and also the people we take on at Farrers. I just wanted a couple of final housekeeping points. For those listening, please do join the rest of the week. Still got 20 sessions to go, and you can log on to entrepreneursweek.co.uk and find out the full details of that. Please feel free to share it on social media, and if you do, you can use our hashtag EW2020. Fill in the poll if you do get the time, but also more importantly, please get in contact with us. For us, this is all about forming relationships in the virtual times that we're in. We really want to hear from you at Farrers. We are really focused on active entrepreneurs and investors, and I personally love talking to them. There's nothing more uplifting than talking to an entrepreneur, because they're fundamentally, if they talk about attributes, they tend to be optimistic as well, and it's lovely to talk to optimistic, energetic people. So just to sum up by thanking you all again, thank you Imran, George, Cash, Zoe and Ian for joining us this evening. Really appreciate your time, and hopefully you'll stay in contact and be involved in the rest of the week. Thank you very much, and thanks everyone for listening.
Thanks all.
Bye.
Thank you.
Thank you.